Hey there, welcome to episode 68 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson husband, and I am on location with two of my co-hosts here in Cancun, Mexico. How's it going, Jay?
It is going great. You guys have beer? Why don't I have a beer? Thank you.
Jay doesn't drink during the day. That's his problem. He's like, let's have a drink. And he's like, no, I don't drink during the day.
If you would have grabbed me a beer, I'd be drinking.
Well, AJ couldn't join us, so we miss you, AJ. But we did record an episode last week and a little extra segment that we're going to play for you that AJ was super involved in. He led a discussion on cap rates. So even though we miss him, he's here with us in spirit while we enjoy the sunshine and drink a few beers.
I don't know about the sunshine. It's been Hurricane Milton's been passing through. So finally got a little bit of sun, but beautiful Cancun, BPCon 2024. It's been a good time.
Yeah, unfortunately, I don't get to enjoy it as long as you guys do. I have to head home to my family to hunker down for Hurricane Milton, making landfall right over my house Tuesday evening. So hopefully by the time you're listening to this, we're safe and sound and the hurricane's passed us by.
All right, well, enjoy this new segment, and we will hit you in the outro.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
So we've talked a lot about interest rates and what's going to happen with the Fed and coming down and how they're going to affect prices. But AJ's got a little bit of data for us and where he thinks cap rates, particularly in commercial real estate, are going, where have they been, and put on a little knowledge session for us. So AJ, what do you think is going on with cap rates?
You know, it's interesting because generally speaking, I think we should first state for anyone that doesn't know what a cap rate is, or else this will be a very confusing topic. A cap rate is just an expression of an expected return. And that's how we use value in commercial real estate. Let me give you an example. If you have $1 million property and that property makes $100,000, not including debt, so it makes $100,000 and you buy it for $1 million, that's a 10 cap. If that property makes $50,000 and you buy it for $1 million, that is a 5 cap. Now, you can also do this the other way around, right? If it is a 10 cap and you buy the property that makes $100,000, that's a 10 cap. But if it goes to $50,000, right, but you still sell it at $1 million, that's a 5 cap. Cap rates going down mean values go up. Cap rates going up mean values go down. That is how we look at it. So some people get that confused because they say cap rates going up. That's a good thing. Property values. No, that's not how it works. Okay. Because the price goes down, generally speaking, this is what we're talking about. The price goes down, so your return is bigger, i.e. cap rates are going up.
So a cap rate is just a multiplier that tells you how much your property is worth based on how much money it makes. And it's actually the inverse of the multiplier. So if cap rates go up, the multiplier is going down. If cap rates go down, the multiplier goes up. When you own a property, you want the cap rate to go down because that means your property is going up in value. Fair?
If you're buying, you want it to go up because you want more of a return. Exactly. All it is a multiple, and it's uses leverage. Now, this is determined, though, and cap rates are not exact science. We got to make sure this is very clear. i.e., what one person buys, let's say, because I do a lot of storage, I'm in storage, a storage facility, and it's a 5 cap to them, it could actually be a 6 cap to me. And you say, how's that possible? Well, they run at a 40% expense ratio and I'm running at a 20%, just to use an example, okay? So then the net income is changed under the different operator. So when you're valuing properties, it's really important that you obviously understand the real net income, because that completely determines whatever the price is, that net income, that value. And so this can be skewed a lot. That's why I say it's not an exact science. It never includes debt, okay? But as a general rule of thumb, we look at the market, cap rates going up or cap rates going down. More investors come into the market, more demand to buy properties. That means that property prices are going to go up because people want to buy. And that then means cap rates go down. Now, interest rates in it. So we'll create this base because I know cap rates to a lot of people are confusing. So we'll keep it just simple like that because that's how it works. But what happens is, and why interest rates are generally tied to cap rates, and the correlation is over the long run, it's pretty consistent. Because in commercial real estate, like all real estate, everyone uses debt. Now, just because the cap rate doesn't include, the valuation doesn't include debt, that doesn't mean that investors don't have to take that into consideration. So as interest rates drop, investors can buy more and pay higher prices because their money's cheaper. If you can get 3% money versus 6%, you can afford to pay a lot more to buy a property because your money is so cheap. So as interest rates go down, generally speaking, cap rates do. And as interest rates go up, cap rates generally go up because investors can't buy as much. So there's less demand. That means the sellers have to give them a better deal to entice it to compensate. Okay. So that's generally what we see. And we'll look at a few charts. All right. Now, why I say generally is there are exceptions to this. It's not an exact science. So that's why when I say people are like, well, what cap rate do you want to buy at? I'm like, oh, I really hate that because I'm like, that doesn't really make sense. I.e., I would purchase a value add property that had big upside for a 3 cap, yet a great stabilized safe asset, I may only want to pay for a 6 or a 7. That seems counterintuitive because generally viewing cap rates in, let's say, a first tier market of a good stabilized property will trade at a lower cap rate than a property that's in a no-name city in the Midwest because it's considered a safer investment. And so more investors want it, especially institutional money.
Well, another good example, AJ, that I use all the time when people are confused with cap rates is, okay, if I have a property that makes $1 million a year, but it's only 45% occupied. And I have another property that makes $1 million a year, but it's 90% occupied. Which one are you going to pay more for? You're going to pay more for the one that is 45% occupied because I know I could go in there and I could get it up to 90% occupied and it's going to make $2 million. So, I mean, not exactly. Obviously, expenses will rise as well, but you get the point that I'm making, that I'm going to pay more for the value add aspect of it. So I might pay a 5% cap rate on the 90% occupied one, but I might pay a 2% cap rate on the one that's only 45% or 45 occupied because I'm paying for that opportunity to value add.
Exactly. So you're going to make more money. Now, that's what we look at and would call like an effective cap rate, meaning that, yeah, but under us, it's going to perform at this level, which that means, like, once again, if it's a 40% expense ratio under him, but it's a 20% under me, that may mean that their 5 cap is literally a 6 cap to me because my expenses are half. So I would say you're selling it at a 5 cap, but its effective cap rate to me is actually a 6. So that's why I say, when we'll show charts and it shows cap rates going up and down with interest rates, things like that. We have to preface this though, because a lot of people use that as a buy or sell signal. That worries me when they say, what cap rate should I buy it at? Right now, when we're looking though at the effects of interest rates and markets, the correlation is very clear, right? I'm going to share here a chart if I can. Let me go to screen. And we're going to look at the correlation. All right. You guys able to see this? So what we're looking at is apartments, industrial, office, and retail. Now, since 1986, you can see that cap rates were in general between 8 and 6%. Now that moved up from 1994 to 1998, where they were all usually right between 8.5% to 10%. Now, since 2002, cap rates went almost consistently down, except for one period, 2008 to 2012, and they kept going down from that point. Now, why did this happen? right? There was a couple things that happened in the early 2000s that made a big difference. That was the Fed's approach, especially after 9/11, to drop interest rates to fuel the economy. That drop that we saw in cap rates follows the drop of interest rates, which we will show here in a minute. And then in 2008, we know what happened. Interest rates had to rise. We had a real estate bubble, a recession. Cap rates went up. They went up from 5 to 7%. All right, Jay, put your math hat on so we can tell people how much of a difference that makes. If I make $100,000 on a property, what is the difference between a 5 and a 7 cap?
So $100,000 at a 5 cap is pretty easy. That's $2 million. And at a 7 cap, it's about 1.5 million.
Yeah. So that's a huge financial difference. Now, this is why everybody, that a little change in cap rates, this can make people literally go under. Okay. A 5 to a 7 cap can destroy an investment because all of a sudden the valuation, think about your bank. You go to a bank and you finance a property and the bank finances that at a 7 or a 5 cap. 2 years later, interest rates go up. Your income hasn't changed. And the bank comes and says, all right, now we're financing it at a 7 cap. Your debt to equity now is very off. I'm not saying this would happen. I'm using it as an example because the change in value to the property is so big, right? So all of a sudden, if you have a very strict like DCR, debt coverage ratio, and you are subject to big changes in interest rates, that is going to affect that asset massively, especially if they're readjusting not only on interest rates, but cap rates. Interest rates go from 3 to 6%, and then your cap rate goes, let's say, from 5 to 7. You're like completely underwater at that point, right? So this is a big change in how we look at it. Now, this only matters if you own a property, if you have to sell or if you have to refinance. We have properties that we don't have to sell, don't have to refinance. I don't care what the cap rate of the effective marketplace is. It literally, I just don't even care about it. I'm making my income. We're trying to build income off of it. So we have always stated, and I've always said, cap rates don't matter. It's not that they don't matter, but we run our business as if they don't. As in, we shouldn't be subject to them because that is a market thing that goes on. Now, you can see why on this other side, for storage, for an example, to illustrate this concept, that the 10-year treasury, how that the cap rates follow it. It's important to notice the lag, okay? Now, the lagging indicator that we've seen since 2021, where cap rates went up, but not nearly to the same level that interest rates did, and the 10-year treasury, which is the big one for commercial real estate, okay? It's the big one overall, but commercial real estate, that's really a big one. Now, that interest rate spiked and cap rates rose, but they didn't rise nearly to the level that we saw in 2008. Now, if you go back to 2007, interest rates went up, but they didn't go up a lot, yet cap rates went way up. So in 2008, values went way down, even though interest rates didn't go up that much. 2021, interest rates went way up, yet values didn't go down nearly as much. So when we look at the effect of markets, we have two examples of very different outcomes here, right? Now, the driving factor is obviously the recession. In one, we had a deep recession that was a real estate recession that affected banks, lending, and capital, that obliterated investors' ability to acquire properties. Now, in 2021, interest rates rising obliterated investors' ability to buy properties, but we didn't have defaults, right? We had better locked in longer term interest rates, but also we have a lot of cash on the sideline and the banks are still working and the capital markets are still functioning. That means that when assets have the ability to trade, so people can decide not to sell, so they're not trading at a higher cap rate, or if they do and it's a good property, lots of those properties will still trade. If you have a premier spot by where Mauricio lives, right, versus a premier spot where Kyle grew up, cap rates are not going to look the same and they're going to be affected differently because Kyle grew up in nowhere land and Mauricio lives in Southern California by the beach, right? So all these investors will want that property where Mauricio lives. They'll pay cash. You're going to get big institutional money that gets their debt that fixed. I mean, you had some of these self-storage companies 3-4 years ago, they went and got lines for billions at 2%. They still have that money. So their money effect is different, right? Whereas if you live where Kyle grew up, out in the middle of nowhere in a farming community, people don't have that and the institutional capital don't want it. And you're much more subject to banks. So you're going to see a bigger swing in values because of how it affects investors. Well, this is the same if you have a recession or not. It has to do with the investors and whether they can buy. Regardless, though, there's still a correlation because it's going to affect the investor pool. Go ahead, Jay.
Yeah, and going off this graph that we still have up here for those watching on YouTube, in the bottom right, we have a graph of the 10-year treasury versus cap rates. And so it's important to point out that obviously, no, I shouldn't say obviously, for those listening, cap rates are going to be higher than the 10-year treasury because real estate's more risky than buying treasury bond. Treasury bonds are, in theory, the least risky investment on the planet. Real estate is not zero risk. And so investing in real estate, you're going to want to get a higher return than you're going to want on a treasury bond. Historically, according to this chart, we're somewhere in the 5%, 4 or 5% difference between the two. So if a 10-year treasury bond's returning 3%, the market's going to say, based on the additional risk of owning real estate, I want 3 or 4% higher than that to own real estate. So 6 or 7 or 8%. And so what we're seeing now, and at the very end of this chart in 2023, we're seeing a very small delta between the 10-year treasury and cap rates.
Can I put up an even more, AJ, can I share an even more shocking
Please.
graph when you look at multifamily? So self-storage looks like they were a little bit more reasonable. Multifamily got a little bit crazy leading up to 2023 and the end of 2022 leading up to 2023. So this is the graph for multifamily. So if you want to talk about how close the gap got.
And so for people that are listening and not watching, Kyle, can you talk through this?
Yeah, so this is the same graph that we were just talking about, except for multifamily, and it shows the two lines of the 10-year treasury versus the implied cap rate. And you could see the lines basically get on top of each other. And we saw this real time. Our cap rates were ending up the same as our loan rates. So we were no longer, one of the best parts of real estate was that arbitrage, right? So where we could get a loan for 4% and we could cash flow 5%. And so 80% of our property or 70% or, self-storage might be closer to 50% of our property. We're getting all these gains in cash flow and we're making the arbitrage because the bank only wants 4% of it. Well, we got into a scenario here with these rapid rises in interest rates where we were seeing negative arbitrage, where our loan rates were over top of what our cap rates are. So our cash flow was less on a percentage basis than what our loan rate was, which means that you're basically eating into your excess cash flow. So if these properties that cash flow great before, you might have a 5.5% cap rate, and they went back when interest rates and when our loan rates were 3%, we were pushing off 7% cash flow a year starting the year one. Well, now that kind of works in the opposite favor. So that's what we got into, and that's where a lot of people got in trouble because that cash flow just went away.
Yeah, so I was just going to say, the big question is, so why, if historically we've seen a spread of 3-4% between treasury bonds and cap rates, why now, and we also, according to the chart Kyle just put up there back in 2008, why are we seeing cap rates and treasury bond yields basically on top of each other, the same exact thing? Why would somebody buy real estate at a 4% cap rate when they could get a zero risk investment like a bond at the same return, same yield? And so in my mind, there's two reasons. Number one, treasury bonds, 10-year treasury bonds, to some degree, they're forward looking, but you have a fixed return. So if I buy a 10-year treasury bond today that's generating a 4% return, I know that for the next 10 years, unless I sell it, I'm going to be getting a 4% return. Whereas on real estate, if I buy something at a 4% return today in multifamily or something else, there's a chance that the return on that is actually going to improve over the next 10 years. If I think values are going up over the next 10 years, if I think rents are going to grow above expectations over the next 10 years, if I think there's going to be a lot of excess demand or less supply than expected, I could think multifamily is going to do better. And so potentially I'm going to pay less or I'm going to pay for a lower return on multifamily today in hopes that that goes up over time. Whereas again, with the treasury bonds, those are fixed. The second piece is I believe that today we're seeing a decoupling of the general economy with hard assets. So historically, those two numbers have kind of been linked at a 3% difference or whatever it is, because people feel like if the economy is getting worse, well, hard assets are going to go down in value. If the economy gets better, hard assets are going to go up in value. And so there's a kind of a correlation or a linkage there. Whereas over the last couple of years, one of the things we've seen is that right now, the economy, some people think we're in a recession. Other people would argue we're not in a recession, but the economy is not doing great. But at the same time, real estate values have gone through the roof, at least single family values have. And so a lot of people would argue that a recession doesn't necessarily indicate that hard assets are going to go down in value. We could see a major recession over the next couple of years, and we could see real estate prices go through the roof. We could see gold prices go through the roof.
And historically, that's true. Interest rates and real estate prices, even when interest rates were way higher than they are today, you did not have a drop. And that was one of my big arguments 2 years ago when everybody, interest rates are going to go, properties are going to fall. I'm like, that's only happened one time in 30 years. One time. And the reason was because the asset itself was the cause of the recession.
Yep. So I think we're seeing a decoupling of the broader economy with hard assets right now, and I think that's one of the things that's going to drive kind of this change in the way interest rates or cap rates and treasury yields interact.
Yeah, I mean, AJ, before you go to your next slide, I mean, if I'm hearing you guys correctly, I mean, the way I see this is that, you know, if all else is equal, interest rates going up and down will affect cap rates, but there are obviously other factors involved in whether something's going up. Inflation, for example, we just talked about that's one big factor. Distress is another one, right? We've had a lot of the rapid increase in interest rates over the last few years has caused massive distress, which is kind of really depressing some of these prices. And then, of course, we had COVID, which really disrupted everything. So, am I reading that right? Though, would you categorize that if all else is equal, interest rates going up, cap rates would go up, interest rate go down, but there are just so many other factors that involve the definition?
And you're exactly right. All things being equal, and generally in the past, right, we see that correlation. I agree, the decoupling. And two, I think there's more reasons because the business models have wildly changed. So if you look at asset classes, the competitive advantage on both money, scale, and all sorts of things, including location. The United States, in general, everybody, is like a tale of two cities. I mean, you go to some states and demand is wild. People are moving there. They're growing. And I have some slides that will show on that. The discrepancy right now in both movement, economics, and everything between states, you have some states that have been negative in a big, big way that is equal to other states that have the upside. You're talking about a 6% spread. Massive within the same exact economy. And so when you look at these assets, location matters. The business model matters. And this is why you do not see, and we've seen different assets trading differently. But the other reason is too, technology. So our ability to syndicate, to operate, to manage from all over the place has increased over the last 15 years, which has created consolidation. REITs now were a big push in that, but you have private equity that has exploded after 2008. Most of the private equity money, which has taken a huge chunk of all real estate, commercial real estate purchases, right, has appeared in the last 10 years, specifically after 2017. The economics of the investors have greatly changed. Now, that doesn't mean there isn't a correlation, and there won't be. At some point, right, if you cannot have buyers because people don't want it or interest rates go sky high or whatnot, there is a correlation. That's why we see it. The degree, though, and how it happens may change. But look at this chart, which I think is a really interesting chart because we talked about two asset classes, for example, apartments and storage. This is something that has been very strange and shouldn't happen. Like it weirds me out. So you have everyone that's sitting here, we have cap rate spreads on storage versus apartments. And the spreads you can see in the overall chart. You see our apartment spreads, and then you see the average storage spread, right? Or the storage average, the apartment average, and then you can see the spread. The reason why I'm showing this chart, everybody, is there was always not only a spread, a fairly large spread up until 2022. And then we had years that actually inverted. And the spread apartments were higher than storage. That doesn't make sense. The reason why that doesn't make sense is I would argue that on a financing basis, apartments are much more secure than storage. Because when you look at the financing, they have long-term contracts. They have much more secure occupancy, right? Now, you may argue, though, that it's a safer asset, which is true on a default level. Storage facilities default at a rate less than multifamily. But investors, as far as cash flow, everything else, it's not the same. And I don't think that should exist. So why in the world then do we have right now, there's no difference between a storage cap rate and an apartment cap rate, where everything about those assets are different? And why did that invert even for a couple of years? I think that has principally largely due to demand. And the one thing that happened right before here was COVID. And what happened during COVID was the government got involved and said, hey, we're not even going to let you collect rents. At that time, you had mass investors move into an asset that was the lowest defaulting asset, but also the highest performing asset in 20 years. But it was the most unregulated one. And so you had a huge shift in capital and where it was trying to go and buy. This shows, though, how the investors, right, and the different trends will obviously affect those cap rates regardless of the cost of money. So when investors move into one asset or another because of outlook, regardless of the capital, it's going to affect the demand and what investors are willing to pay. These trends are really large. You're talking about 100 basis points, which we earlier showed the effect of 100, 200 basis point swing on the value of an asset. This is not small, right? These are really, really big trends. And I don't think that this is something that's going to go away due to the private markets, as in these swings due to this investor pool of money that is not only dictated by financing. You have REITs, institutional, and private equity that can raise money and don't even need financing. That movement is more important than the cost of the money.
So AJ, does that timing correlate? So like if you go back to that last one, like right when in 2020, when that shift came over, does that correlate to like the REITs getting involved? Because I know it became a pretty big strategy for people like you when all of a sudden the REITs were interested in storage, where they could like basically take smaller properties and either bundle them or expand on them and put them kind of in that range where the REITs are interested, and the REITs are just able to and willing to pay such a lower cap rate that it was very lucrative for people with storage complexes.
I think REITs, but actually the bigger driver, REITs were a huge factor, but the bigger driver hands down was private equity. Private equity was buying at mass. And two, when I say private equity, everybody, I'm talking about people deploying billions. So they're on par with the REITs, and you have lots more of them. You have 5 or 6 major REITs, But you have private equity companies that are bigger than those REITs, that are bigger than, I think there's probably only 2 REITs, and you have lots of them. Then you have smaller private equity firms that are deploying hundreds of million, and there's lots of those. And so I think that effect of private equity moving into the storage space was really, really big. And that's why you had them on par with apartments, which I don't think should happen. I would not pay in general, and all things being equal, I'm saying, value add. Of course, I have my different modes of operating, but if we're just looking at like a stock straight, everything being equal, an apartment should go for a lower cap rate than storage. It should. And so when you look at it that way, you can tell that it really was purely investor preference based upon the current conditions, because they were both affected by the same interest rates. And this is like what Jay was talking about.
Is there one other factor that might have played a part here? Availability of opportunity. So it may have been that they would have preferred to invest in apartments or retail or office or, well, I don't know, but something else other than storage. But we know that in the multifamily space, there's been so little transaction volume over the last couple of years that they probably couldn't have bought a lot of properties.
Well, the yields went way down, right? So people start chasing yields, and they start moving into, like, if you stay in the apartment space, that's why like tertiary markets got so expensive, because traditionally people, the big boys wouldn't move into those tertiary markets, but then yields got so thin that people started pushing out of that. So I think, Jay, like when you're talking about maybe pushing into not just into other markets, pushing into other industries.
Yeah, I know a lot of people have this idea that being BlackRock is awesome because you've got billions of dollars, or being a hedge fund or being a pension fund is awesome because you've got billions of dollars to put to work. Problem is, when there's not a lot of deals out there, when there are not a lot of good deals out there, well, you still have to put those billions of dollars to work, because you can't just stick it in a treasury bond. Most people that are investing in hedge funds or BlackRock, they could invest themselves in treasury bonds. So if you're only investing in bonds, they're going to pull their money out and invest somewhere else. And so you need to be putting it on a risk. You'd be putting that money into a risk on asset, an asset.
Well, and you pay a premium.
Yeah.
The premium to deploy $1 billion versus 10 million is massive. So if I have to deploy $1 billion, I have to buy huge amounts of property at once. That's called portfolios, and those are traded at a portfolio value. So there could be a 200 basis point spread on a portfolio versus an individual property. Once again, if you think about value, that is an incredible spread as far as value goes. So generally speaking, as smaller investors, they can find better opportunities and they can actually get better deals and ones that have more upside. Because if I have to deploy $1 billion, value add, I can't do. I can't go deploy and try to turn around all of these assets that cover $1 billion. So you're right, Jay, absolutely. It is actually, it can be Warren Buffett said this. Warren Buffett was like, if I had $1 million, I could get way higher returns than he can today. He's like, I could get way higher returns, not even close. And this is very, very true, especially in real estate, because that big capital, they have to pay. The cost of deploying it is actually really hard. It gets to a point where REITs now, especially in the storage space, storage properties aren't nearly the value of office or multifamily. So you can get into storage from $2 to $10 million. $10 million is a big facility, right? Think about if you have to deploy $1 billion and you're talking the highest storage facilities can go, or like maybe 10 to 20. You have the big boys, but that's rare. That is not the market. So even the big ones in big cities, it's 10 to 20 million bucks. What is a big regular apartment building in a city like Austin or Southern California cost?
We won't look at anything that's like less than 10 million. 15 million probably wouldn't even look at.
And under 10 million is the meat of the market for us, right? That's it. And so it gets really hard to deploy kind of capital like that. And I think what you saw during this time was, first of all, inventory was a problem for everybody. And it was really interesting because in the last 2 years, storage has, I would argue, performed way worse than apartments. Rents went down like not even close to what we saw in apartments. We had 20% drop 2 years ago. Occupancy dropped 15%. So then why in the world aren't cap rates going much higher, right? And it's purely because of appetite for that individual asset class, which kind of defies expectations.
Well, AJ, can't it just be math too, though? Like if you're saying that basically you're implying that your NOI is going down, right? Because your occupancy is going down and your rents are going down. So that would just mean that your other side of the equation and the cap rate is going down. So if the other side's going down and the cap rate stays the same, then that value is still going down.
Well, cap rate should go up. If a property is performing worse and worse, so if you're looking at a trailing 12 and income's dropping and occupancy is dropping, I'm not going to pay a 4 cap because that means next year I would have paid a 2 cap because it's dropping. So there should be a hedge.
Going back, unless, yes, if you're seeing a trend and you believe the trend's going to continue, you're not going to pay that. But going back to our previous example, if you believe it's going down and you think that okay, the occupancy is low, the rents are low, I can get both of those up, then maybe you would.
Yes, that is correct. And there's a lot of that. But two, I think it's also affected that transactions in this asset class, like other asset classes, I think all of them plummeted. I mean, I don't know about you guys in multifamily, but I know that in, industrial, portfolios are not selling. We were having $1 billion, plus portfolios. It was just
they're down 60%. I think the last number as I saw for transactions.
Exactly. And so I think that has happened. And I think the lack of trading assets actually is why cap rates haven't come up. If people were forced to trade, cap rates would have to come up. I think, though, it's easy for cap rates not to come up if nobody's selling. The only reason cap rates haven't come up is because there's not a sell to show that. Because the person that owns it's like, I just won't sell if it's at a 6 cap. It's not because investors are willing to pay lower cap rates. They're not buying. They'll only buy at a certain level.
And to our point before, the ones that are selling are the ones that are distressed, and people are going to pay lower cap rates on ones that are distressed because they have value adds.
Exactly, which we'll do today. I will take a distressed property and I'll pay aggressively because of the upside that it has in it. Now, this is really, this becomes this idea, though, that we're talking about being nimble. And if you're getting into commercial real estate, this is one of the best reasons why today I honestly believe is the best time to be in commercial real estate. Another thing that has occurred massively during this time, off-market deals and seller financing. So seller financing has become a really big thing because let's say that you are an owner and you say, my property is worth $10 million. And I go, well, it was when it was 3% interest rate, but at 6%, it's only worth 8 or 7. And they're like, well, I can't sell it for 8 or 7. Well, that's fine. Then how about this? You be the bank and give me a 2% interest rate, and then I can buy it for 10. So the option they have here is I can either sell it for 7 or I can seller finance it and I can get much more of the value. And so we see lots of that happening today. And a lot of these deals are off market. They're not even recorded. We don't even know what those cap rates are, right? Because the listings that have gone on the market, they have fallen out. And we saw this 2 years ago start where basically everything that went to market, it either traded a lower price or it didn't trade at all. And sellers were getting burned because brokers were saying, and they believed we could sell it, but the market was changing so quickly that by the time the listing went out, interest rates had already gone up 200 basis points and nobody was going to buy it at that. So then the seller took it off the market. That is really, really bad if you're a broker and if you're a seller. Listing a property, going through the work, putting it out there, and it not trading, right? That's not good because the broker, first of all, did all the work and now he's not getting paid, right? And then the seller is burned. You wasted my time. Maybe my employees are mad. We had planned on this. And so what we had is this huge spread between buyers and sellers. As this happened, all of a sudden now the fear of listing a property and it not selling became huge. So instead, brokers got buyers and went to a seller and said, I have a buyer today at $8 million. Will you accept that? And they said, yeah. And then the off-market deal would happen because the owner doesn't want to list it and go through all that. It's like, no, if you have a buyer at this price, just bring it to me and I'll transact, because they're so scared of listing them.
Or the one that happens all the time in multifamily is actually a property does transact, but it doesn't get to the finish line, right? So you see an interest rate change, to your point, or something happens along the way, or it's like right now it's tough to raise capital. So if you have a syndicator that thinks they're going to be able to raise the money and can't, and all of a sudden, as you mentioned before, you don't want to go through that again, right? As a seller, you don't want to have to go and fully market this. So what you do is that falls out, and you say, "Hey, we had this under contract to sell for 33 million. We would take 32 right now. Would you be willing to take this at 32?" And they just go out to a few people, and that's where the off markets are happening in multifamily.
Exactly. And this is where it comes down to, in times like today, when we have high interest rates and the economy is struggling, but we're still arguing whether we're in a recession or not, i.e., some people feel that they're in a recession, other people don't. And this is where it comes to the output, and what's happening in the states are wildly different. So if you're purchasing a property in, let's say, a state like Illinois that's growing at almost negative 1% versus a state like Texas that's growing at over 1.5%, this is going to dramatically affect what you're willing to pay and what your expectations of performance are. The United States doesn't grow equally. That doesn't happen. And the discrepancy may seem small at 1.6 versus negative, 1 or versus negative 1. That is not a small, though. Just because it's a small percentage does not mean the outcome is small, right? The difference of the United States growing at 2% versus negative 2% is catastrophic. That's a bad recession, right? Versus we're growing really well. That affects everybody all the way down. So what we're seeing is investors, how they're deploying capital, and commercial real estate is localized, everybody. Very localized. It services a local market, a local area, and that can be for a lot of real estate down to just a couple blocks. Like, you can have commercial real estate that you have like storefronts in it, different thing that's only serving basically the small little population which it serves. So this localized nature of the spreads, when interest rates go up, we don't have a luxury of paying things so at high prices. So we're seeing the spreads of cap rates get very, very skewed. This happens more in third tier markets. So when Kyle was saying when nobody could get yield in first tier, they went to third tier markets. I tell people that capital is like oxygen. When that oxygen goes away, it retreats, and the middle America just gets sucked. Like, there's nothing there. It's gone. And at one moment, all of a sudden, you're getting 4 caps in Pascagoula, Mississippi. Interest rates go up, and now you can't even sell.
Is that a real place?
I don't know. Sounds good, right? So, but then interest rates go up, and not only are you not getting a 4 cap, you can't even sell it. There's literally no buyers. So when it's there, you don't think about it. But when it's gone, it kills you. And we see this with interest rates and markets. So when you go into, Mauricio's neck of the woods, they're like, we really haven't seen a change in values. But then you go to Pascagoula, Mississippi, and they're like, I went bankrupt. I can't sell my property. The the spread that we see in markets today in the valuation and cap rates, how interest rates affected it. If I have money, I now have opportunity to buy. I'm going to Austin, Texas versus Illinois because I'm a buyer that has money and I can actually close and purchase a deal. I don't need to go to Illinois to get yield. I can go to Texas that's growing at 2%. And so when you guys are looking at real estate, commercial real estate markets, and you're looking at cap rates and expectations, right, and how that's going to run and what's happening nationwide, you have to remember that just because you saw a graph like that we posted or somebody posted, oh yeah, cap rates haven't budged. But then you go to Pascagoula, Mississippi, and they've gone up 400 basis points. Not only have they not budged, the value was cut in half. That's happening right now. We're buying properties in some locations that I'm buying at not only below replacement cost, I'm getting at $39 a square foot. That same market 2 years ago was $150 a square foot. So that's not happening though in Austin, Texas, or where Mauricio live. That doesn't exist. You're not buying it under replacement cost, right? So there's a lot of opportunity here, and interest rates today have, I agree with Jay, it's kind of decoupled the larger market. And so just by looking at and saying, oh, cap rates are going up or down, or they should be, we're not seeing that today. And there's certain areas where I can get good deals, others there I can't. That also means you have to be more careful. You have to be much more careful in environments like this. Because obviously if a seller in Pascagoula, Mississippi if you'd buy it for a 5 cap, they'd sell it to you. That doesn't mean it's a good deal. So there's great deals out there, but you have to be more careful with them. That makes it harder for money managers to deploy capital. And it makes it really good for small people and small investors, but small operators to find great deals. If I have $100 million fund and I'm just hiring a property management company and I don't really know anything, all I am doing is allocating capital. I'm going to look and just say, well, we're not allocating it in these sectors because I can't get it. And I'm going to look for other sectors, or we're going to move big, massive money around. That then means we have lots of buyers that can't find sellers and are willing to do seller financing, seller at a higher cap rate, but there's not buyers. You can really take advantage of it. And that part of it is very exciting to me.
I think it's important to point out too, when looking at deals, cap rates don't equate with deals, right? You don't necessarily, so when like AJ's saying like, okay, if it's if people are paying a 5 cap, I found something for a 6 cap, that means it's a good deal. We like to say, and AJ made this comment kind of before, and I'll just say it more succinctly, that cap rates don't matter when you're buying. We all have our standard underwriting practices. We all have the way that we determine what a good deal is. And usually most people, the way they do it is they take a crap ton of data and they throw it into their underwriting model and it spits out a number. And that is, we can look at one property that is next to another property and we can offer a 5.5 cap on one and a 6.5 cap on the other, even though they're next to each other and offer the same product. It's just, level of renovation. Like there's a lot of different things that can go into determining what it is. So don't just immediately think that, okay, if this cap rate's higher than this one, then this is a good deal, because typically that's not the way it works.
Just to put a finer point on that, and yes, I'm holding a dog right now because it's thunderstorming here and she's a little scared. But to put a finer point on that, we don't care the cap rate that we buy at. Keep in mind, if a property that we're looking at is heavily distressed, it could be losing money. If a property is 50% occupied, doesn't mean that it's making money. It could be losing money, and a property that's losing money is literally a negative cap rate. So if you're buying value add, you may buy a property that's generating a negative cap rate, that's losing money. And so that just puts a kind of a finer point on the fact that we don't care what the cap rate is going in. We care what the cap rate is after we've stabilized and coming out.
Oh, absolutely. This is why I tell real estate investors, you're buying a business, you're not buying a real estate asset. It's to try to get that across, because I think a lot of people look at this more like stocks. The stock market's up or down. I'm buying it why values are down, or I'm buying it why values are up. That's not how this works. It doesn't translate like that. But it does translate to the fact that I think it's much more affected when there's cheap money. So when there's cheap money and money is free, values they just explode, because people have to place money, and they'll do it for tons of reasons, depreciation or just to move money. That can really make it hard to find anything worth buying, because there's just so much money out there, right? And people are doing crazy things. They're getting into it. They have different plans. They have different strategies than you do. And then all of a sudden, all values tend to go up in unison. So that's why you saw in Mauricio's neighborhood a property selling for a 5 cap 3 years ago, and then in Pascagoula, Mississippi, one selling for a 5 cap. That shouldn't happen. But when there's so much money out there, that happens. Demand is so high that everybody's buying kind of everything. That changes and erodes very, very quickly. And you need to be careful when you're investing in third-tier markets, even second-tier, first or fourth-tier markets, fifth-tier markets. You see those huge value swings. And there was actually a private equity firm in the storage space 3 years ago that was raising and deploying hundreds of millions of dollars, that their thesis was, and they argued, cap rates in third and fourth tier markets would not change ever again. This was their first time investing. They were really good at raising capital, and capital was really easy. That did not play out well at all. So,
well, it's an interesting idea right now too, though, because it's as things get frothy and get expensive, people, as we said, chase yield, and that brings the spread between these first market cap rates and these tertiary market cap rates. That spread comes down, right? So, before, when things weren't frothy, the cap rates in Austin were 5%, and the cap rates in Amarillo, Texas, were 8%. Well, all of a sudden, as cap rates came down, Austin went down to 4%, but then Amarillo went down to 5.5%. And so the idea is that now that we've seen these cap rates come up a little bit, we've seen these tertiary markets come up even higher. Those spreads have widened. There's that theory going on. We bump around it. We haven't fully committed to this, but we bump around with the idea that, hey, at some point there might be this, okay, tertiary markets might be where we jump in, because once things get a little bit frothy again, then we will see that spread come down, and we will see a little bit of a value add just by cap rate compression happening again.
Absolutely. Now, that's when we're talking, like what Kyle's saying, looking to the future. So if we're now looking to the future, this is why when the Fed, and why we talk about interest rates a lot, everybody, the reason why we talk about interest rates a lot is due to what Kyle just said. When interest rates go down and money gets free, we see things change. Money starts to not only chase yield, chase anything it can, and it disproportionately affects certain regions. And those disproportionate swings are big, both to the downside and to the upside. And that money coming in changes the landscape overall of commercial real estate in a really big way. So when we're all sitting here looking at the next coming 2 years, there's two sides that we're looking at for interest rates lowering. For us, we look at it, the overall economic impact. So intrinsic value, okay? So the economic impact will affect how that asset works and what it produces. So not counting what it costs, we're not talking buyers and sellers. I'm talking about intrinsically the revenue of that asset will have more customers, more demand. Interest rates go down. You all of a sudden have people that are doing better. They can afford more. The economy picks up. That means we can charge more, right? And so you can get revenues that will rise. Now, on the extrinsic side, which means the actual asset trading in the marketplace between buyers and sellers, you get disproportionate number of buyers versus sellers, and that makes prices go really high. So that is one of the biggest effects overall that we see with interest rates and why we track it. We do believe, and I think everyone agrees on this podcast, we've talked about this much time, that we are in this new cycle. This new cycle will mean a lowering of interest rates on an ongoing basis. The speed at which we guess at, we don't really know, but I think we all think that interest rates in 2 years from now are going to be lower because the Fed set a new course and we're in a new cycle. That means a lot of people will start to say in 2 years, the assumed value of properties could be higher simply due to interest rates going lower. And there's a lot of people that will start investing, and that starts to pick up. The lower interest rates go, the more that assumed value increase becomes. There's kind of a lag. When interest rates rose, sellers didn't all of a sudden just raise their prices, right? And that's why transactions stopped. The spread between buyers and sellers was huge. That also happens in reverse. Finally, sellers are coming to the table and they're reducing their price when interest rates are going down because they have to sell. These are people that have to sell. That will continue for a little while until interest rates and then sellers start to increase the prices. This is a magical window. This is like, I'm so excited because this is my favorite time in the market cycles where sellers are adjusting to high interest rates. They're lowering their expectations and the price, but the cycle's already changed. So I can get good deals that I'm now at the bottom or close to the bottom, or you could say the proverbial bottom. We don't really know, but we're at the beginning of that new cycle. That means we can buy good deals and we can actually execute on them right as things are turning around on a macroeconomic scale. So think about 2009 to 2012. That was that era. This won't be as long of a window, though, because we don't have a real estate crisis and the financial markets are working. The reason why that period of time was so big, 2009 to 2000, I mean, you could even argue further than that, was due to the financial markets not working. Even though banks were saved, they weren't deploying money. So there were still no buyers. Where today, interest rates being lowered will have a much quicker effect because there's lots of cash. The financial markets are stabilized. So we expect our firm, our thesis that we're running on is we have about a year window and it'll adjust. That depends on how fast interest rates go down. So it'll be a much smaller window of opportunity to catch it, I believe, right before. But we think that that's here, and that's what we're viewing as far as cap rates and prices and how interest rates will affect it. We have a year of probably good prices where that spread will start to close and we can get discounted to us deals right before it changes. What about you guys?
We're the same thing. I think it's, the nature of the beast is we've decided the playground that we play in, it's a little bit tighter. There's a lot more sophisticated people. I feel like because you're buying sub $10 million properties, you're kind of avoiding a lot of these bigger, more sophisticated players where we kind of have to factor them in, and they kind of see the same stuff as us. So, but that doesn't mean that we're not agreeing with your premise. This, like, we're aggressively trying to buy properties still. We're still seeing a lot of sellers holding on to their prices. We've also seen a lot of the distress, to a lot of people's surprise. A lot of the distress got refinanced, got worked out, got pushed down the road. A lot of people still kind of having that 2025 in their head that they're going to keep holding on until things get better. So we haven't really been able to capitalize on distress as much as we thought. But as far as where we are in the market cycle, we're all in kind of on that. We do believe that we're at or close to the bottom. I believe we're at the bottom, and we've already kind of headed up. Most of the data says that we're heading back up as far as pricing is concerned. So yeah, we're pretty optimistic. Mauricio, have you seen? So you would have the finger on the pulse on transactions, right? Because your business is going to be dependent on how many people are doing deals. Are you seeing transactions pick up yet, or are you still waiting?
Yeah, I'm starting to see it. I just don't know if it's another false start because I've seen it before. I saw it at the end of last year as well. I saw literally November-ish really pick up, and then it just kind of dudded down. But it's probably been a good 45 days now that I've seen a noticeable increase in folks coming back out. People who haven't done deals in a couple of years are coming out and wanting to do a deal, or new people. So I've definitely noticed it. It's definitely something that's been going on in the last month or two.
And do you think that how was it when interest rates were low compared to the last? How's that changed for you when you're looking at transaction deals over the last 3 years? I mean, you were in it when interest rates were free, and then it went all the way up to 8.
Yeah, we had a booming. I mean, right after COVID, which we had already been doing pretty well in terms of transaction volume going up. COVID, obviously, for that 3 or 4 month period was a complete dud. I mean, it's literally no transaction volume rather than 2018. I'm sorry, in 2020, between like March and August, there was like almost zero. Nobody was doing deals.
We got one done.
Yeah. But then it took off again until literally 2.5 years ago. So whatever, June or July of 2 years ago. And that's when we peaked. And since then, I can confirm sort of the stats that you gave, 60%. For us, it was about 65% volume drop from our peak in July of 2022 to the end of 2022. It was over 50% drop. And then since then, it's kind of stabilized, and we've kind of been at that lower thing until literally, I would say 45 days ago, where we're starting to see an uptick.
How do the documents change, Mauricio? So and what I mean by that is when money's easy, everybody, it changes the documents, how you set up. It changes the splits, what you can ask for. But when there's not a lot of money and only a few investors they can demand more in general. So the cost of capital, so to speak, and the terms, we see that in our business change wildly. As in what we can get, what we can ask for when money's free from investors, and how we set up those docs as far as terms is way different when money is not around and you have to do things to entice investors to come in. What do you see?
Yeah, but the challenge is, when everything was sky high and people thought that, there was like an expectation from LPs that, hey, I'm going to get 18% IRR, 22% IRR, real estate goes up. I'm expecting these high numbers. And what we've seen over the last couple of years is sort of reality set in and just people realizing they're not going to be getting 18, 20% returns in this current market. So the expectation has come down a little bit in terms of what the overall IRR is. I would say it's closer now to like 15 if it's a really good deal. I haven't seen a difference in the splits. I mean, some folks have kind of, reintroduced the preferred return, which had started to go away a little bit, but I'm still seeing the traditional, at least in multifamily, the traditional preferred and then yeah,
AJ, I think it went through a little time there where people started demanding more, but then as there's a lot of these deals that aren't doing well started to happen, like reality, to Mauricio's point, kind of set in, where now they're like, oh, okay, so you haven't had any capital calls and your deals are doing okay. Then, because it used to be like, we were like, hey, we got this deal. It's, 14 IRR. This is a great deal. You should come in. They're like, well, this guy over here is doing 16. We're just going to invest with him. And you're like, well, we looked at their underwriting. They're underwriting a, 4.5 cap rate exit. Our underwriting has 5.5. And they're like, well, no, but we'd rather just go for the higher upside on the deal. I'm like, okay, and now people are kind of just realizing, okay, like that 1% isn't everything.
Yeah, I think people are realizing the risk. It's that risk-adjusted piece that people were forgetting. People are just looking at the returns and not realizing there's a different risk between one deal and another. And now people are realizing, oh crap, real estate doesn't just go up automatically. Oh crap, I don't always get my distributions. Distributions get paused. I don't necessarily have to have my distributions. There are cash calls. Things can go. People losing their money. So I think the reality is set in. So, but just to wrap it up here, in that sense too, is that I do think over the last few years you've had a ton of mom and pop retail investors coming into the market. A lot of mom and pop and retail syndicators or private equity funds that are at the smallest scale coming in that didn't know what they were really doing. And so those folks have gotten burned. And I think there's a lot of apprehension right now of people trying to get back in. So there's a divergence between what you guys, meaning the fund managers and the syndicators who love what's going on, you want to take advantage of these things, you think these are great opportunities. But I have a lot of folks that are having a hard time convincing their investors that this is a good time because they've been burnt. They've already come through 2 years of pain, and to extract or to get those funds from investors, it makes it harder. So to your point, Kyle, earlier, there are a lot of folks that will get into contract and then have to bail because they just weren't able to raise the capital, because there is a sense of concern still in the LP market, and it's just harder to get them to part with their cash.
Well, hopefully those syndicators come back, because that's what drove up the prices on our current properties that we own, and we want to be able to sell them for high prices. So we hope they come back at some point. Just wait for us to buy a few properties first and then come back and buy them back from us. All right. We wrap this up. We good? All right. You got Mauricio in here. We're wrapping up things at BiggerPockets. Jay had to emergency get a flight out of here, go back, take care of his family for the hurricane. So you're just dealing with me. And surprisingly, guess who ended up on stage? This guy. So I was making jokes. I was the only one not speaking at BiggerPockets, and I ended up speaking at BiggerPockets, taking Jay's spot. So
it was awesome. Kyle crushed it. Much better than Jay. Obviously, Jay's just going to go on and on and on for 30 minutes. Kyle went in there, did it nice and succinct, made his point, got one investor to invest with him. So great job, buddy.
There you go. Appreciate it. But we had a lot of fun. We spent some time with Kathy Fecky over here, previous guest on our podcast. It was her birthday, little birthday celebration. Now we're done presenting, so now we can enjoy a little bit. Maybe the hurricane's out of here. Maybe go get some sunshine, some drinks, and have some fun.
Dude, I gotta go catch a flight, so I'm gonna go catch a flight and head back to West Coast, away from the hurricane, and looking forward to getting back in the studio next week.
All right, so we will. My drink is just starting. So I do still have to go with the head because I just got off stage, but I will see you next Tuesday.
Wait.